Back here, the housing recovery just continues to struggle on. New, closely watched data showing a double dip in home prices. CNBC's Diana Olick going inside the latest Case-Shiller report for us. Diana?
Well, Bill, we've been reporting the double dip in home prices for a while now, but the S&P Case-Shiller report is widely followed by the banks and by Washington. So today's report just puts an exclamation point on the whole thing. Take a look. Home prices fell in 18 of the top 20 cities this report follows, and on its quarterly national index, prices are now down 5.1% year over year.
We have erased the gains that we saw over the last year or so, and we're back as low as we've been any time in the last decade.
But Blitzer adds we're going back to the location story here in D.C. We're the only market in the positive year over year. Not so for Minneapolis, seeing a steep decline. Much of California, though, doing better, with L.A. and San Diego declines somewhat tempered. Chicago's rough, and, of course, Florida, cities like Tampa and Miami, still very weak.
Just about everybody agrees we're going to miss the seasonally strong period in 2011, which will be starting, or we should be at the very beginning of it right now with May. But nobody thinks that will make any difference. Everybody's now keeping their fingers crossed for 2012 and wondering whether people just don't want to own homes anymore.
And I also want to point out that this report is measuring sale prices of homes which went under contract about 6 months ago. And we've seen considerably more weakness in the market since then. Now, we'll be talking about how this is going to affect the bank balance sheets on the blog and on Power Lunch. You'll want to watch for both of those. Melissa?
All right, Diana Olick, thanks so much. I think so. Home prices take a double dip. We also have QE2 coming to an end soon, and new economic growth forecasts being revised lower. What does it mean for mortgage rates and the housing recovery? Joining us now to talk about all that is Susan Wachter, professor of real estate and finance at Wharton Business School. We also have Adam Leitman Bailey, real estate attorney and author of Finding the Uncommon Deal. Thanks to both of you for joining us. Susan, what does all that mean to you? Does it mean, as you heard in the report right before you, is it possible that people don't want to own homes anymore? Do you think prices are going lower? What's the bottom line?
Well, prices are going lower. In short, the bottom line is there's a glut. And in those markets where there's a worse glut, that's where you see the downward price pressure is the greatest. And we're not going to get out of this, and it's affecting home buyers' confidence. So those who are moving, perhaps with their children for a new job, they're renting.
Susan, when you say that prices are going lower, can you put a guesstimate on this? How much lower, and when will we find the bottom?
Well, even now we're seeing this is a slide. This is not a dramatic decline, but we're not going to see a bottom until 2012 because the growth is coming from job recovery, but that job growth is not as strong as we thought it would be either.
Adam, if I'm an investor or looking to buy a home right now would be the time, wouldn't it be? I mean, you want to buy into a weak market and rates are as low as they're going to get, I would think, at this point. What do you think?
It's a double-edged sword. This is the greatest time in the history of modern real estate to buy a home. At the same time, you can't go shopping unless the lenders are giving you money to shop with, unless you're extremely wealthy. So as of October coming up, lenders are decreasing jumbo loans from 625 or from 729 to 625, and in many states 417,000. That means that borrowers are not going to qualify for loans, and if they do qualify, they're going to be paying much, much more for those loans, and as a result, be able to borrow much less.
But this is an investor market. So if you're coming to the game with equity and you're buying to rent out, it makes sense in many markets.
And Adam, Susan said that it all depends on where you are. I mean, all real estate is local. And if there's a big glut in your market's likely to go down further. If there's not a glut, then maybe you're near a bottom. Do you agree with that theory?
No, it's not true. Because remember, we are run by the lenders. We're not a nation that buys with cash. We buy with loans. We put down very little, and we mortgage our places for many years.
Except for the investor.
Right, no, the investor's cash is king.
Exactly, and they're there, and they're buying in some markets.
But Adam, you didn't really explain why Susan's wrong, though, about the glut in the market. Why does that not pertain to prices?
No, the glut's there. The glut will put more inventory in the market, and it'll have more homes. The more homes you have in the market, the more prices go down because there's more inventory, and the buyers have more to choose from. Sure. That's one piece. The bigger piece, though, and the foreclosure glut is an important piece, but the bigger piece is if you cut how much you have to spend on buying a home, that's going to drop prices heavily. But there's good news in this.
That's what
I don't disagree with Adam. That part of it's important too, and in fact that's yet to come. That we're tightening further, is especially in the markets where that's going to impact a problem.
Susan, Diana Olick just made a very brief reference to this, but the U.S. banking system is in question here. I mean, how vulnerable is the U.S. banking system to another potentially major downleg in the housing market? Are they prepared for that?
And that's the good news. The federal government's finally realizing they need to get out of housing.
Well, they're stuck in it now with over 800,000 homes on their balance sheets at the moment. Another million coming down the end of the year.
And Fannie Mae asked for $6 billion in May. Yeah. They're bleeding money. So by pulling back lending, pulling back money that they're going to lend, and if they stop guaranteeing 9 out of every 10 loans, then the economy, the corporation called the United States of America may survive.
Susan, do you want last word on that?
How about Mandy's question about the vulnerability of banks to this?
Well, the banks are vulnerable, but the housing market is backstopped right now by Fannie and Freddie. While we must withdraw them from the market and bring private capital in, the cost of credit, as Adam just said, is key here. So we can't withdraw the supports too fast, although the banks will be seriously.
QE3 coming, huh?
But I like that the federal government's realizing that they need to stop guaranteeing loans, and they're slowly pulling out. It's going to be a horrible, horrible occurrence if they pull out quickly, because homes that will be 50% of what they're worth are going to cause a major problem in the United States of America as far as home buyers and consumers. So we need to do it slowly, and we need to somehow incentivize private capital to invest in loans.
Don't rip off the Band-Aid too fast.
Thank you both for joining us today. Appreciate it very much. Very interesting conversation.